Amazon is a sales juggernaut. As you can see here, sales since 2001 have grown at an average rate of over 24.58%. Add weekly closing stock prices to the graph, and you will notice that the stock price followed the sales of the company very nicely. Now, it did get kind of high. The normal price to sales has been 2.53. But in the last couple of years, with all the hype and hysteria, the price to sales got up into 3 times sales and even up to above 4 times sales. Today, you can buy this company at 2.14 times sales, which is below its historical price to sales number, making it an extremely attractive company and maybe making it too cheap to ignore. The performance, if you'd owned this stock for over all these years, $10,000 would have grown into $1,745,000, averaging 28% a year. Very close to the growth of sales that the company generated. Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. And what I'm doing today is I'm going to cover Amazon for you, because in the last video I did where I talked about the S&P 500, the SPY to be precise, the ETF, I'd left out Amazon as one of the top 20 holdings, and it was an inadvertent mistake. It was actually to be included in there. I just missed it, and I got caught up in the video and I forgot to talk about it. So I owe you guys a video on Amazon. But the reality of it is Amazon is also a very important company to look at. I don't care if you're a growth investor or a dividend growth investor or a pure income investor. There's probably room in everybody's portfolio to have a little Amazon. And since Amazon has become so attractive here recently, now could be a good time to go ahead and start building a position in Amazon if you already have it. Now, by the way, I'm not suggesting that Amazon has bottomed. You know, I always talk about the fact they don't ring a bell at the top or the bottom of a market, and you never know when a stock is going to bottom out. And there are some reasons why people are a little nervous about Amazon, and I'll show you that when I get into earnings. Earnings are expected to fall just under 99% this year. But as I'll go into the video on Amazon, it's never really traded based on earnings anyway. It's been a function of cash flow and a function of sales, as I showed you in the intro. So let's go ahead and take a look at Amazon here, and let's look at the company over the last 20 years, going back to the beginning of 2002. Now, the first thing I want to do is I want to go into the earnings metric. I've got sales here, which I talked about. I'm going to go into operating earnings. And one thing I want to point out, there's a big disconnect between the company's operating earnings and its stock price. Because for one thing, the company made very little in the way of earnings in the early years. They even had years where they lost money, believe it or not, or didn't make any money. Now, as time has passed, earnings growth has gotten a little bit better, and it's actually starting to average, it's averaged 40% since 2017, but the stock has still traded at a very high multiple of earnings, almost 100 times earnings. And there were times when the stock traded at well over 200 times earnings. So earnings have never really been the way to look at it. And as I mentioned a few moments ago, the company is expected to have a real bad year this year. Earnings are expected to go from $3.24, and right now current estimates are for about 4 cents. And these numbers will vary depending on what analysts you're checking, but that partially explains what's going on. Now, if I looked at Amazon for this year, and I'm going to talk about this more later in the presentation, Amazon so far in 2021 has fallen about 35.9%. We'll call it 36%. That's actually more than the S&P did. And I talked about that in my last video, and I'm going to revisit that here a little bit later in this video because I want to talk about missing the points of the video. But Amazon is down, but when you look at it from earnings, it doesn't look all that attractive. However, if I look at other metrics like operating cash flow was down in 2021. It's expected to rally by over 30% in 2022. And the stock originally reacted to that, but since we've been in this kind of bear market here in the last month or so, we see that Amazon has dropped to the downside again. And it's currently, you can buy this at a blended price to cash flow of just under 19, where its normal price to cash flow has been closer to 26. And its actual cash flow growth going back to the beginning of 2017 has been about 27.86%. That would be the PE. We're using P equals growth rate formula here to value this based on cash flow. So the price to operating cash flow of 28, we'll call it rounded, is actually a reasonable valuation. And again, you can buy it at 18.88 times blended cash flow right now. So looking at it from a cash flow, looking at it from other metrics such as EBITDA, the company also looks cheap. It has a normal price to EBITDA recently of about 35. You can currently buy it for half of that at a price of 16.15 times EBITDA. So it looks very, very attractive there. And again, I want you to notice EBITDA growth has been very strong. And I should have mentioned that when I was looking at operating cash flow. Operating cash flow has also been very strong, except for that 1 year in 2021. But otherwise, it's been very, very good. And of course, I talked about sales in the beginning of this video. Sales growth, even in these more recent years, is still averaging over 20% a year. And if I'm looking at forecasting, sales are expected to slow down to about 14%. But because you can buy the company at such a low price to sales of 2.14, the normal price to sales is 2.53. That's what this orange line is here, would be a price to sales of 2.53. This actually gives Amazon a margin of safety relative to its normal sales. Now, one thing you can also do, you can go into other websites, like you can go into Yahoo and you can look at, growth rates that are expected. Now, earnings are expected to grow at 33% for the next 5 years. So let's go back and look at Amazon from a standpoint of operating earnings. And let's look at what, the estimates are. The estimates are for very strong growth in 2023, followed by even, strong growth again in 2025. So earnings look like they're going to rally. I do want you to notice, and you can look at this in fast graphs, the company did split their stock in June 20-1, and that's brought it down into a reasonable price of around $107 a share, which is, very attractive relative to what you used to have to pay to Amazon. But when you're looking at the metrics that count for this company, the operating cash flow and sales, the stock looks like very, very inexpensive. So if you were going to buy this stock, I would say now's the time to buy it. Now, you can go into other sites through the external links here. For example, you can go into Seeking Alpha Research, and you can look at the company's earnings expectations. This is by Standard & Poor's. They've got earnings dropping at 98.58% to 5 cents. Our analysts have it dropping to 4 cents, as I pointed out earlier. But you can go into these sites like this and look. Now, you can go into Morningstar. Morningstar currently gives Amazon 5 stars. And I do want to point out that their 5-star price is $115 a share, and the stock is trading at $106. So, fair value, they say, is $192. Now, that's an opinion, but you can go here and read. If you're a subscriber, you can read all about the company. Now, you can also go into Zacks, and you can go into the Zacks report, and they talk about Amazon is gaining on solid Prime momentum owing to ultra-fast delivery services and strong content portfolio. They also say a strengthening memberships with third-party sellers is a positive, and you can read this full article, including the overview. You can also go into NASDAQ and look at what the NASDAQ analysts have the low value of the stock at 118, the high value at $200 a share. So there's a lot of room. And these are the analysts. You can also discover what analysts are actually following the company by going into NASDAQ here. So all in all, the bottom line is when you're looking at Amazon, I think Amazon is an extremely attractive stock right now. And even based on a sales growth of dropping down to 14%, significantly lower than historical norms, you still would have an opportunity to make double-digit rates of return over 20% a year owning the stock. So I believe if you're ever going to buy it, you want to buy it now. Now, this leads me into another segue. This is, again, I owed you, the viewers, a video on Amazon because I left it out when I did the video on the S&P 500, the Spider Trust, the SPY Trust. Now, I talked about that, and I said, my title was The S&P's Down 30%. Well, I got a lot of pushback on that. People say it wasn't down as much. So, here I've got the SPY marked for 12/31/21, 1 day before this year. And I calculated through yesterday's closing stock price, which, the SPY was down $8, down 2.28%. And the problem is the annualized loss has been 30%, but the actual loss has been 24.7. Okay, and even when you add dividends in, the S&P, the SPY was down about 29% annualized. That would be if you follow it out through the rest of the quarter. If it didn't move from here, you'd have an annualized, loss of growth of about 30% and a total loss when you add dividends back in of about 29.1. But there are some factors here I want to talk about. I am not recommending it today, and I didn't recommend it in the other video. I wasn't pointing out that now is the time to invest in the S&P 500. I got a lot of comments telling me the market's going to drop X number more points and blah, blah, blah. Well, I'm not really too interested in that. What I'm simply showing you is that the market has corrected from being overvalued. So the main point of my first video, and I'm going to re-support it in this video, was we've gone from a very high inflated market to a market that's starting to look reasonable. It's not reasonable yet, even in my opinion. I wouldn't call it reasonable until the market was trading at about, the SPY was trading at about 329, and it's at 357. So it's not far from being in fair value. Of course, I'd like to see it below this orange line, which I consider the intrinsic value. But as you notice, very rarely does it ever get that inexpensive. But at 16 times earnings, it looks pretty good. Now, the other comment I got was, well, the earnings, your denominator's wrong. The earnings are going to be much lower for the S&P 500. Well, what I wanted to point out about that is the S&P 500 is a composite of 500 stocks. And I also talked about that. So I went to Investopedia here, and these are the top 25 components by market cap of the S&P 500. I covered 20 of these with leaving out Amazon in the last video. You can see Apple dominates at almost 7%, Microsoft at 5.6%, Amazon in its own right is over 3% of the composite. So you add all these up and you get 20-some percent of the market is dominated by these top 25 companies. And there are 500 companies that are in the S&P 500. And of course, these are the top 10, going down to Exxon at 1.36. Now, there's a lot of other statistics you can learn about the S&P 500. But the point is, one of the things I've talked about, for example, it's 26% information technology, 15% healthcare, 11% consumer discretionary and financials. Those are the big four. And then it really drops down quite a bit after that. Communication services are still at 8, so are industrials, but you can see materials are down to 2.5. But it is a diverse index. Now, one of the points that I always make, and I got a lot of questions on this, so I want to cover it, when I say it's a market of stocks, not a stock market. So let's go back here and revisit this number. Okay, we'll be pure and say the index is down 24.7 prior to today. That was through yesterday's close. Okay, but what it's a market of stocks means, if I go in and I look at other of these constituents, this is fast graphs, which gives you the whole S&P 500. You can actually look at this and you can actually create a portfolio on valuation and find the cheapest value stocks by going into these different viewpoints. You can do it by PE ratios, and you can do this by going through here. I've done this in videos before. I'm not going to do it now. But the point I want to make is if I look at some of the constituents, so the market's down, we'll call it 25%, not 30, okay, if you want to nitpick me, a little less than 25. But NVIDIA, okay, which is one of the top 20, if you calculate what it's done this year, it's down over 61.8%, almost 62%, annualized at over 70%. So it's a market of stocks, not a stock market. The individual stocks that make up the market have very different performance than the market itself. United Healthcare, in contrast, which is also one of the top 20, is actually up 2.2% this year. It's having positive rate of return, annualized at about 4%, and it's still significantly overvalued, even though, as I showed you, the market itself is starting to become reasonably valued. This is what I mean by it's a market of stocks, not a stock market. It's the individual stocks. The devil, as they say, is in the details, but so are the angels. And you can find good value in any market, and you can also find overvalued stocks in any market. Now, not to beat this to death, VF Corporation, the old Vanity Fair Corporation, is another one that's down over 60%. So there are a lot of companies like Visa and others that are down maybe just barely into double digits, etc. But when you look at the overall market, you need to recognize that the SPY is dominated by a small group of stocks, and it's really heavily influenced by technology. And that's something that, you should all be aware of. And technology is where we're starting to see a lot of drops. Even the mighty Microsoft, I think if I recall, was one of the, top 5 stocks, and their Microsoft has fallen precipitously from being massively overvalued. I covered that. So the bottom line is, it is a market of stocks, not a stock market. And the way I think people should invest their money, if you want to invest in the market, go ahead. If you want to do it the easy way, I personally like to build portfolios one company at a time, and I like to do it by studying and analyzing each individual company that I'm looking at and determining whether or not I think they are a good buy or not. I'm not really that interested in what the overall market has done or is going to do. I'm more interested in what the individual stocks I'm interested in investing in. So when I say it's a market of stocks, not a stock market, that means because of these 500 companies that make up the S&P 500, you'll find a great deal of diversity here within this group. All kinds of different companies with all kinds of different valuations. Some of them pay dividends, some of them don't pay dividends. So, one of my favorite phrases that I coined is mind your owned, OWNED, the businesses that you own. Mind your owned businesses. Quit worrying about the market, quit worrying about the economy, quit worrying about interest rates. Pay attention to why you believe the individual companies that you're looking at are capable of growing and at what rate, and leave all that other stuff out of it. Anyway, this has been Chuck Carnevale saying thanks for watching. I hope you enjoyed this update on the S&P, but most importantly, I hope you enjoyed my little talk on Amazon, which I inadvertently left out. Anyway, thanks for watching. I appreciate all of you as always. If you like the video, ring the bell, give me a like. Also, take a look at Fast Graphs. What a great tool. There's so many things you can do. It's a very dynamic, very powerful tool. You can evaluate growth over all kinds of different time frames. You can evaluate valuation using all kinds of different metrics. You can get into the company's financial statements. It's really, to me, you're at a big disadvantage investing in stocks without it. But of course, I'm biased. Thanks for watching.